I've got my Fireside's almost empty now. I've got my Fireside Chat. And let's bring on my guest, David Nelson. As I mentioned, the founder of Bumped. How are we doing today, sir?
I'm doing fantastic. Good to see you.
There we go. Good to see you. Good to hear from you. Let's start with this. Tell us about Bumped, what the company does, and then we'll go from there.
Man, I don't know. I think I might need to go get a Red Bull here so I can just keep pace with what I saw over the last 5 minutes.
I apologize profusely for that.
That's great. I loved it. So Bumped is a new company that's helping turn everyday spend into ownership. And so if you like going to Starbucks and getting your coffee and getting some free Starbucks stock when you do it, that's what we're all about. We're about turning shoppers into shareholders, rewarding in fractional shares of stock when you spend, and in the process, building true loyalty or ownership in the brands that you care most about by rewarding in stock and giving consumers the pride of walking into a store and feeling like they have a little piece.
So maybe you can explain how it actually works, though. So if I'm at a Starbucks and I got my venti, whatever the hell they have there, how does it work?
Yeah, so really there's two ways for consumers to earn. First, they link a credit card or debit card in the Bumped app. After they link their card, they choose what brands they're loyal to. Are you loyal to Dunkin' or Starbucks? Are you loyal to Netflix or Hulu? And then when you go spend with that linked card, you start earning shares of stock in the associated company. So that's one core way. We call that the loyalty section of the app. And then the other element is we've got a whole bunch of brands, in fact, almost 1,000 different brands that are willing to reward you in stock when you go to their location. So you can shop through the web and buy stuff at a variety of different brands, Kohl's and others. And when you do, you earn stock at whatever % reward they're willing to give in the stock you've selected to earn in the cases where they're not publicly traded.
Could I be loyal to both, like Dunkin'? Well, Dunkin's private now, but could I be loyal to both? I don't know, Netflix and Roku, or I don't know.
Yeah. So in the loyalty portion of the app, no. In the loyalty portion of the app, your goal is really to get behind a brand and to have that sense of pride of ownership. So, for example, we have Uber and Lyft in there. Once you become an owner in either Lyft or Uber, why should you be using the other one? And that's sort of the concept. You actually become an owner in a company, and so you stay loyal or true to that company. And so we have a variety of categories that work like that. But then we have that other portion of the app where you're able to choose from a variety of different offers and earn stock that way. So we have sort of two sections of the app that work a little bit differently from one another.
And how are those reward rates determined? I guess the company determines that, right?
Yeah, I mean, part of it is obviously every brand is a little bit different depending on the category that you're operating in, and the dynamics of every company is different. So obviously a grocer is running on thinner margins than retail for clothing or what have you. So I think you'll see percentages really vary depending on the vertical that the brand happens to be in. But the other portion of this is really the brand. The brand is playing with the brands offer a certain rate that they're willing to reward, and we work within that and offer as much as we can to the consumer.
Can you give us some idea of like different verticals and how their reward tiers may differ?
Yeah, sure. I mean, in the offer section, you have a great variety. It could be 1%, it could be 5 or 10%. So it really does shift. I think clothing brands tend to give larger rewards in general. They're operating off higher margins. They have a lot more competition within the category. Some of the brands that are a little bit more mainstream or have less competition, like the grocers as an example, or gas as an example, you're going to see a lower % reward because they're operating off thinner margin.
Right. When you say like 5 to 10%, you mean what do you mean? What does that mean?
So if you were to, for example, go to a Kohl's store and spend $100, you could get $5 back in stock. And under that circumstance, in the offers portion of the app, you would actually choose your 5 favorite companies. And then when you shopped at Kohl's, you'd get $5 of stock in the companies that you selected to get rewarded in.
Got it. So it's not as if you go to Starbucks, drop $20 and get a share of stock. That's not how it works.
Yeah, you get in the case of Starbucks. So let's use Starbucks as an example, which happens to be in the loyalty portion of the app. You would choose to be loyal to Starbucks. That's a 1% reward. So if you spent $5 at Starbucks, you would get a nickel back in SBUX Starbucks. So in that particular circumstance, you would actually be becoming a shareholder in Starbucks with every cup of coffee you bought.
So obviously we're talking like super fractional shares, which it's hard to remember, but as recently as I don't know 3 years ago, fractional shares was not a thing that most places offered, and now I feel like most major retail brokers have some kind of fractional share offering. It's gone from the thing that was like in one little corner of the markets and financial services to a thing that's been adopted, wouldn't you say?
Yeah, you're right. I think even as you look at some of the cryptocurrencies and so forth, people are much more accustomed to the fact that things don't have to be done in whole lots. And stock's really no different. You're a shareholder in a company, whether you own 0.4 shares or 40 shares. And I think the other element of this is just lots of incremental fractional shares of stock add up over time. And over time, you end up with whole share lots, which is fantastic. We had done a study and the first couple of years of Bumped, and we started rewarding a lot of consumers across a lot of categories to see how this impacted the consumer. And the Columbia School of Business actually approached us independently and wanted to research that. And so the other angle we came from is what happens when you give grants? What happens when somebody chooses to be loyal to a brand like a Red Robin or a McDonald's, and you start them out with $5 on day one? We actually found under that circumstance that there is even a bigger affinity for loyalty, starting them with that larger portion right up front.
I'm sorry, I just had a question and I was trying to share my screen and I got distracted from my question. And so, okay, let me forget that. And question from chat that I think I know the answer to, but I'll ask it anyway. Tax implications. I would imagine this is just like any other it's a taxable event when you sell, and that's it, right?
Yeah, we really have to go off what we see in the market. And if you look at most of the rewards programs in market, where lots of us are benefiting from points programs or cash back or miles programs with our credit cards, we really look at when we reward the consumer and it's part of a transaction, it's sort of a rebate. So you get say a 2% reward in something in stock, your basis is whatever you got the stock at.
Right.
However, if you experience gains over the course of time, let's say you end up with a couple $100 of stock in your account, and that couple $100 moves to $240 and you liquidate, you would have $40 of gains.
I remember what I was going to say before. It's the same concept as Acorns, right? Which is like investing pocket change. This is sort of like that. It's pocket change in the form of your retail transactions, or not just retail, but whatever transactions over time. And the idea is it's not about the one, it's about the one over years and years and years, and the compounding effect really adds up there. So it's a very similar concept if you're familiar with Acorns. What other verticals, we've mentioned a few, what other verticals are all companies on here, or like what is the selection like?
Yeah, if you look in the offers portion, you end up seeing a lot of really big brands in there. The Lowe's, like I said, just about every vertical ends up participating at some point in time, but they're offers, right? So they kind of come and go. They could be in there for a few months and then not in there. However, the loyalties portion we try to keep much more consistent. So they tend to be smaller incremental rewards, but the consumer has that experience consistently, and they start building those stock positions. So I think that's how come we differentiate these two things. between the loyalty concept and the offers concept, if that makes sense.
Yeah. So we've talked about, I guess the chain goes from transaction in the real world to a stock reward. But what about the other way? Are there rewards for already being an owner? Do brands have offers like, hey, shareholders, and is that part of the platform?
It's an interesting question, which is what happens once you create 1 million or 2 million consumers who are shareholders in a company.
Right.
I do feel like there are some brands out there that in fact do have some ways that they give perks to people who happen to be shareholders. I think that's something that really becomes even more of a thing. And there's even some other folks and companies out there that are focused on that key concept, which is how should the consumer be, once a consumer is actually truly loyal to a brand and they actually have a share position, what are cool things you could do for that customer? Because it's fundamentally a different customer to market to, right? For any company or merchant.
So this is not a new concept. There are other companies out there. I've spoken to a few of them. Ticker comes to mind. What separates you? What separates Bummed from the other similar platforms out there?
Yeah, I mean, I'm not aware of any companies doing it quite from the angle that we're doing it at, but I do love that there's lots of people that realize that ownership as a form of reward is special. And so I think the thing that separates us is we're truly an enterprise company. And what I mean by that is we're working with these brands to find new and innovative ways for them to build relationship with their customer. And as you can imagine, this is a two-sided equation, right? The brands want a bigger, stronger relationship with their customer that results in them shifting their spend away from competitors and being more loyal to that brand. And the consumer wants something to stand behind, as well as to understand the markets and become a shareholder and experience the pride of, walking into a Starbucks and actually being a shareholder, or taking an Uber ride and knowing that that's a company you actually have a share position in. So I think that is sort of the angles that we're coming from. It's hard for me to speak to some of the other companies and what their objectives are.
But the idea of like shareholder rewards is not a new one. Why do you feel like it doesn't seem like to me it's really caught on that much? Why do you feel that is?
Yeah, as I analyzed, I raised a pretty large capital round to go build this company. And as I analyzed the market space, I realized, hey, I'm not the first person to say that if somebody was an owner in a company that they would actually spend more with that company. In fact, there was some research out there that indicated as much. However, nobody really dove into this concept and conducted a really big study. So as you can imagine, it's hard to scale something without showing merchants and the brands that this really is something that they need to take seriously. And so what we've done by approaching this marketplace from a perspective that nobody ever has, which is running a very large study and then having that study get independently verified with somebody like Columbia Business School, I think it was a key. It was a key to making this area work, because I could walk into a brand and I could say, hey, I think this is going to be amazing for your customer. But you have to have data that backs it up. And so to have an independent, research study done that says, yeah, you know what, when somebody becomes a shareholder, they really do spend 40% more with your company. And by the way, if you start them with a $5 grant of stock, that very well may double their spend. These are the types of research and studies that needed to occur for this new market space to exist. And then it's also what you alluded to. We needed fractional shares, understanding of fractional shares. We needed the Robinhoods of the world to exist, such that we made Wall Street able to handle this concept of, what if you just gave somebody 15 or 20 cents of stock at a time? That's not something you really could have done 5, 6, 7 years ago. I don't think Wall Street was ready for that.
That sort of answers my question, which is like, what is the incentive here for the company? What I guess you just sort of answered that is customer stickiness or
it's not just the fact that they're spending more with you. It's the brand advocacy. So we see that upwards of 40 to 50% of consumers literally become strong brand advocates, which you've probably seen out of your friends. I mean, once you're a shareholder in something and you shop there, you're much more likely to talk about it. You're much more likely to push a friend or family member to go frequent it. So This, for the brands, this is about building relationship and at a time that it's sorely needed when there's lots of competitive forces, especially from some of the really, really big online players.
I mean, it goes back to like the old Peter Lynch philosophy of investing in what you know, and theoretically what you know is where you spend your money. So it's just like, and this is what I wish I had done this. I didn't, but like if I could go back in time and like at 16, 17, I would have like bought a stock that I knew, like a brand that I knew and used just to see what happened. You know what I mean? And I think that's like the best way. Personally, I think that's the best way to get people interested in the markets is buy stock when you're young. It doesn't matter what it is, as long as it's something that you've heard of and you know the product and you're a user, and then you get involved that way, and that can be your entry point into investing. I wish I had done that, but I hadn't. But this is a good avenue for that because it's basically linking your purchasing power with investing and stocks. I see a question from Cam in chat that I'm going to bring up. Oh, not that one. That I want to bring up here, and I mean, the answer is sort of logical, but by the time I get to one full share in rewards, am I paying the same as getting one full position, or simply buying it over a year, or am I getting a deal on my position by the time you get to one whole share? So, Cam, your average cost basis is going to be your cost basis. It really that fractional shares work the same as real shares in that you're paying what at the market, right? So it'll depend on what the market does, however long it takes you to accumulate one share, but your cost basis will always be the average of what you paid for each transaction. At least that's my understanding. I've never actually owned any fractional shares, but is that how you understand it, David?
Yeah. So in other words, if you were to get $1 reward in a $50 stock, it's going to be based on that for that day, that $50. And you're going to end up getting basically a 2% of a share, right, in that position. And then that's going to happen time over time. Let's say that stock is $40 a month later. Well, you'll actually get slightly more of that stock based on that reward. And then if it goes up to 60, you'll get slightly less of a share. So it's cost averaged over the course of time. But after you shop there 20, 30, 40 times, maybe you have a full share of stock in that company. And the price is whatever the cost average is. It might be $47.12, right?
It just depends on what the market does, unfortunately, but that's kind of how this game works. Here's a good question. So I guess what kind of company is bumped? You're not quite a payments platform. You're not quite an investing platform. You're not quite a gift card company. What kind of company? Or maybe you're all three. I don't know.
I love that question. Actually, the last company I built was bringing digital gift cards into the marketplace. So that's what I did before. This company really is a story of ownership. And we look at ourselves as really the first ever ownership-oriented brokerage. This is not necessarily a story of trading, like trying to buy low and sell high and do day trades and things like that. This is really about giving that sense of long-term ownership over the course of time, compound interest, compound wealth generation over many, many years. As well as just feeling that sense of pride of like, hey, I actually have $100 of stock now in a particular company. And I have that sense of pride when I walk into the store. One of the things we noticed that I think was really interesting is that people didn't sell their positions. I don't think it's somebody's first thought once they've got $15 of Starbucks to sell that $15 and convert it into cash. I think people have a lot of pride at walking into Starbucks and being an owner. And so to answer that question, we are a company that is really formulated around building relationship between brands and consumers. We're the first ever brokerage that is focused on ownership rather than stock trading. And we try to facilitate that. The world is unfortunately slanted in some ways, which is why you've actually seen some crazy things happening, like the GameStop situation. People are much more aware of the stock market. 20% of the households own like 93% of the stock market wealth. And so how do you change that? How do you get people involved to learn and educate themselves and become excited about the market? We're a fantastic entry point for people to start learning and understanding the stock market before they start trading.
Yeah, that's a really important stat that you just brought up there. I think the number was like 55% of American households own stocks. That means 45%, and that's just any stock. That's not that's not a majority of the. That's just you own one share of one stock. You're in that 55%. That means about a half of Americans don't own anything, and even in the ones that do, it's skewed really towards like the whatever it is, like the 10% own the vast majority of those assets, and that's of course how they got that wealth. So how does Bump make money? Like, what is your business model here?
Well, anytime you create a situation where consumers become more loyal to a brand and you can create acquisition for a brand, that's a situation where you're able to get the merchants to pay for that situation, right? So under the case of using like an Uber and a Lyft as an example, if you can share shift and cause people to not shop with the competitor and start riding with the other competitor, brands will pay for that. Brands are excited to make their customer a part of their story. If that results in share shift, if that results in actually building a relationship with the consumer. So we ultimately end up making money from creating that relationship, and the brands and merchants end up paying for that at the end of the day.
We're on with David Nelson, who is the founder of Bump, I guess a stock rewards and ownership company. David, is there anything else that you I think we covered most of the questions from chat going through here? Yeah, I think I got most of them. Is there anything else that you wanted people to know?
Yeah, I mean, hey, if you like building small incremental positions every time you get a coffee, come experience what it's about and help us build a platform that could be really great for a lot of people. We continue to make it better. We have a lot to learn. We're still going through the normal process of being a startup and improving the platform, getting more brands engaged and involved, understanding how it all works. But we really appreciate anybody who's a part of our story as we build it.
And I should say it also includes e-commerce, right? It's not like you have to physically go to a Starbucks.
That's right. Yeah. Tons of offers where you can shop online, and then obviously several that you can go in store.
All right, David Nelson, thanks a lot for joining us today.
Thank you. Thank you for having me. Really appreciate it. Great questions.
Have a good weekend.
All right. You too.
Nice long holiday weekend, Synthetic Friday. All right. I hope you guys enjoyed that.